Most people think financial crises are unpredictable disasters, random storms that destroy everything in their path. But what if that's completely wrong? What if every major collapse in the last 100 years followed the same hidden pattern? And what if only 3 types of positions survived every single one of them? From 1929, to the inflation inferno of the 1970s, to the 2008 credit meltdown, to the COVID shutdown, to the inflation shock and rate hikes of 2022, no matter how different the crisis looked, the same 3 survivors always emerged untouched, even stronger. But here's the real mystery. If the pattern is so clear, why do financial institutions never teach it? Why do economists pretend each crash is something new? And why do ordinary investors lose everything over and over again? Today, we uncover the truth, not predictions, not theories. Just the hard reality hiding inside a century of economic destruction. And by the end, you'll know the 3-position structure that protected wealth through every collapse, and the 3 lessons that might decide who survives the next one. But to understand the pattern, we have to go back to the moment the illusion of infinite prosperity first broke. Origins 1929. The system we were never meant to see in the roaring 1920s. America convinced itself that the stock market was a permanent money machine. Newspapers encouraged families to borrow everything: savings, mortgages, even furniture loans, to buy stocks. The economy looked unstoppable. But beneath the party atmosphere was something else: artificial credit expansion, manipulated interest rates, and a market inflated far beyond real productivity. Insiders quietly sold. Outsiders kept buying. Then came October 24, 1929, Black Thursday. Panic hit Wall Street like a shockwave. In 2 days, the market erased years of gains. Banks began collapsing. Credit evaporated. People ran to withdraw money, only to discover their savings were gone. Jobs vanished. Factories shut down. Families went hungry. It was more than a collapse, it was a full-scale economic reset. And yet, a small number of people quietly protected their wealth. They weren't diversified across dozens of assets. They weren't leveraging stocks. They simply held 3 types of positions that behaved differently from the rest of the financial system. While markets lost 90% and banks fell like dominoes, these positions retained value, gained purchasing power, or even rose. This was the first confirmation of the pattern. But the world didn't learn from it. Rise the 1970s. When money itself broke, jump forward 40 years. By the late 1960s, America faced a new problem: rising deficits. Expensive wars, slowing productivity, and growing global distrust in the dollar. In 1971, Nixon closed the gold window, severing the last link between the dollar and real value. Overnight, money became an abstraction, a promise, backed by nothing. At first, the economy boomed. Cheap credit returned. Consumers spent freely, but cracks began to form. Oil prices surged in 1973, energy shortages spread, inflation accelerated, unemployment rose. Economists were stunned because everything was breaking at the same time. The dollar fell. Stocks stagnated for nearly a decade. Bonds failed to keep up with inflation. Savings accounts lost real value year after year. It was the first time modern America experienced the nightmare of stagflation, high inflation, low growth, and rising fear. But once again, the same 3 positions that survived 1929 survived the 1970s. Stores of value soared as currency value collapsed. Productivity-driven sectors became the backbone of recovery after inflation peaked. Panic hedges protected those who held them during the worst moments. Another crisis, another survival. Still, the world ignored the pattern. Breaking point, 2008. The credit bomb. By the early 2000s, the global economy had a new addiction: debt. Households borrowed, corporations borrowed, governments borrowed. Banks packaged debt into complex instruments no one truly understood. Investors believed these products were safe because mathematicians said so. But math doesn't protect you from reality. Behind the scenes, banks were leveraging unstable mortgages. Real estate prices were inflated beyond income levels. And the entire system depended on one assumption: home prices never fall. In 2006, that assumption cracked. In 2007, it fractured. By 2008, it exploded. Lehman Brothers collapsed. A global panic followed. Credit froze. Companies shut down. Markets fell nearly 60%. Millions lost homes, savings, and retirement accounts. But once again, a small minority survived because they held the same 3-position structure: value stores, productive essentials, and fear hedges. Every other asset class crashed together, including supposedly safe ones. Diversification failed again. But the world still didn't learn. Fallout 2020-2022, the global freeze and its aftershock. Then came one of the strangest crises in human history. A virus forced the entire world to stop in a matter of weeks. Factories shut down, borders closed, supply chains snapped. Demand collapsed. Then, government stimulus injected more money into the world economy in a few months than in entire decades. Asset prices soared while the real economy was paralyzed. People celebrated stock market gains without understanding the cost. Inflation was building like a pressure bomb. In 2021 to 2022, the bomb went off. Inflation surged to 40-year highs. Food and fuel costs spiked. Tech stocks collapsed. Interest rates rose at the fastest pace in modern history. Housing affordability evaporated. Investors who thought the crash was over after COVID were hit again, this time by the fallout created by the solution. And once more, the three-position portfolio survived while everything else fell. Why? Because the system was never fixed. It was only delayed. Failed fixes. Why crises keep returning. Here's the twist that almost no one talks about. Every major crisis of the last century was created by the fix used to solve the previous crisis. After 1929, the government injected credit into the system. That credit fueled the inflation problems of the 1970s. After the 1970s, interest rate manipulation and financial deregulation set the stage for the 2008 meltdown. After 2008, massive stimulus and near-zero interest rates inflated everything for a decade, leading directly to the volatility seen during COVID and the inflation shock of 2022. Every fix created a distortion. Every distortion created a hidden weakness. And every weakness eventually collapsed. But the three-position system survived all of them because it wasn't dependent on the manipulated parts of the economy. It was built on fundamentals: value, productivity, and fear protection. The repeating pattern, the three that always survive? Look, across nearly 100 years, and the pattern is unmistakable. Position 1 protects purchasing power when currency fails. Position 2 grows when the economy eventually recovers. Position 3 shields wealth during the moment of impact, the panic window. Together, they form a self-contained, crisis-proof structure, not a prediction system, not a trading strategy, a survival model. And it works because it's designed for the sequence of crisis events. Breakdown of trust gives contraction of credit, gives collapse of currency, or demand gives restructuring, gives recovery. In each phase, one position dominates. Others stay steady. None collapse together. Position number 1, the real value anchor. This includes assets that maintain value when money loses meaning. In 1929, it was gold and hard stores of value. In the 1970s, it was commodities and energy. In 2008, it was tangible assets unaffected by credit defaults. In 2022, it was inflation-resistant assets that rose as currency weakened. The core principle is simple. When the system manipulates money, value must anchor somewhere. Position number 2, the productivity engine. This includes essential industries, innovation sectors, infrastructure, and real-world production. These are the assets that rebuild the world after each crisis. In the Great Depression, it was industrial revival. In the 1980s, it was technological and manufacturing expansion. After 2008, it was innovation, digital infrastructure, and emerging productivity sectors. After COVID, it was logistics, energy, automation, and essentials. These positions don't depend on hype, they grow because humanity needs them. Position number 3, the fear hedge. This includes defensive instruments that rise when panic rises. In 1929, it was cash-like instruments and liquidity anchors. In the 1970s, it was short duration and alternative hedges. In 2008, it was volatility and safe haven assets. In COVID and 2022, it was strategic defensive holdings and risk-off plays. They aren't for long-term growth, they're for survival during the shock window. Modern parallels: the 2020s look eerily familiar right now. The global economy contains elements of every past crisis combined. 1929-level debt, 1970s-level inflation, 2008-style leverage, COVID-level supply shocks, political polarization comparable to the 1930s, financial engineering risks like the 2010s, and demographic slowdown that the world has never faced before. When multiple cycles overlap, corrections aren't gentle, they're violent. Which means the next crisis, whenever it arrives, will likely hit harder and faster than most expect. And if history continues to repeat, the three-position structure will again be the difference between survival and destruction. Takeaway 1, diversification is a trap in real crises. In normal markets, diversification works. In historic collapses, everything falls together. Stocks crash at the same time. Bonds correlate with stocks, real estate lags behind. Cash loses buying power. The safety is an illusion. Takeaway 2, the three-position portfolio survives because it obeys economic reality. Stores of value protect you from currency manipulation. Productivity positions grow the world after destruction. Fear hedges shield you during panic. It's not magic, it's alignment with how economies actually behave under pressure. Takeaway 3, the next breaking point may arrive without warning. Technology accelerates shocks. Debt cycles compress. Political instability shortens recovery windows. Crises that once took years to develop now unfold in weeks. Preparation matters more than prediction. Final warning: crises don't destroy wealth, they transfer it. From people who assume the system will save them, to people who understand the system's weaknesses. From people who spread money thin, to those who hold the three positions that never fail. From those who chase trends, to those who study patterns. Call to action: if you want deeper breakdowns, portfolio structures, and crisis cycle analysis, Subscribe now, like the video, and share this with someone who needs to prepare before the next shock arrives. Because understanding the cycle is one thing, but acting before it hits is what protects your future.